Okay, good morning, everyone. I think we'll get started now. If you are here for balance sheet paralysis, you are in the right place. We are joined today by our friends from the Darling Consulting Group. If you've been on any of these webinars over the last couple of years, they provide a wealth of information as well as some sometimes scary insights as to what's going on and what you can prepare for, but always with some great solutions. My name is Bill Nagel, and I manage the educational programming at the Cooperative Credit Union Association. Just a couple of things. This will be recorded, so it'll be available for you, for yourself, or to share with colleagues. When it's done, it'll be available on our website. And also, if you have any questions as we're going through, please use the chat feature. I'll keep an eye on that as we're going through. But also, I know our presenters will open it up to Q&A at the end if you'd like to ask a question. And so with that, I'm going to turn it over to our speakers. Today, we have Joe Kennerson. He's the managing director at Darling Consulting Group. He's been with them since 2005. He has benefited from working with nearly 1,000 asset liability committees throughout the country on ALM and strategic initiatives. He lives in Boxford with his wife and 2 daughters. He's an active member of Big Brothers Big Sisters, thumbs up, and he's a graduate of the University of New Hampshire with a degree in finance. Also speaking today is Eric Poulin. He has been with Darling since 2014 as a financial analyst, and he has continued to work closely with the implementation, development, and education for Darling's decision support tools. He currently lives in the Seacoast area of New Hampshire with his wife. He's also a graduate of the University of New Hampshire, but with a degree in economics. Gentlemen, thank you again for being here with us this morning and sharing your thoughts, and I'll turn it over to you.
Go Wildcats. Thanks, Bill. Thanks. It may get a little scary today, I guess, with a title with paralysis in it. It seems like it could get a little scary. And what Eric and I mean by balance sheet paralysis is that managing interest rate risk is tough today. Managing margin, just holding on to margin, is hard. Probably the hardest it's been in our careers, right? And it's because we've been living in this world of extremes. You think about interest rate extremes. You go back and, we had almost a decade of zero interest rates, right? Zero bound, Fed policy. And then we went through a little bit of a head fake of a tightening cycle, and then things turned and COVID hit. And we went back to zero bound on Fed funds rate. During that time frame, we also had the 5-year Treasury rate hovering around 50 basis points for about a year. Right. And of course, we've turned the corner, and here we are up over 500 basis points with a massively inverted yield curve. Extremes. Okay. Balance sheet extremes. We were handed boatloads of deposits in 20 and 21, effectively in our space, had about 5 years worth of deposit growth in 18 months. During that time frame, it was almost forced, where we had a lot of refinancings of assets at probably the lowest coupons in the history of our industry. Again, turn the corner, and here we are. The money supply is shrinking, right? Deposit mix is changing, and those legacy assets, of course, have extended. Extremes. And so in this world, it's changed risk profiles, and it probably makes it difficult, right, to continue to have confidence in understanding who we are, our risk position, right? For our team members, our stakeholders, our board members to have confidence, right, in who we are. And that's the paralysis that we're talking about. So how do we get beyond this, right? Because there's some huge decisions to make, with the balance sheet and where we're at and where potentially we could be going. So that's the backdrop for today. In our, we've got some high-level objectives that we want to leave you with, as we go through the webinar. Number one, how do we gain more confidence in our risk position? And we'll talk about this in the way of, using data analytics, right? How do we tell the right story? How do we have the right reports and storyboard to take our team on that journey? Eric's going to get a lot into that piece of it, right? Talking about our story, listening to our balance sheet. That's a little bit of a dorky mantra we have here at Darling Consulting Group, but it's hard to avoid the pundits, right? To avoid speculation in listening to what's happening in the outside world and taking that in how we manage our balance sheet. That's hard to do, especially today, right? It's like we've hit decade highs of Treasury bond rates, I think today, And now all the economists are on this, one side of the boat here saying we're going to be higher for longer on interest rates. You almost want to be a contrarian, right? To when that shifts, and always bringing it back to who the heck knows? What is it about me? What keeps me up at night, right? And how do I want to make balance sheet decisions based upon who I am? I had an ALCO meeting yesterday. This client is truly asset sensitive, It's just their business model, right? We made decisions where we took a little bit of yield, a little bit of income off the table to protect against a massive Fed pivot, rates going back down. Not because that's where we think rates are going. We don't get to decide where the yield curve goes. It's because that's what keeps us up at night. That's where our biggest risk is. And that's really hard to do. I understand that. And then finally, this one hits close to home. We get calls probably 3 or 4 times a week, in regard to this, like, hey, my ALCO, man, it's just kind of like we're going through the motions, it's check the box type of process. And especially in today's world, how do we use ALCO as a vehicle to deal with all the headwinds, the challenges, to drive strategy? That might be the ultimate objective for today, because take a look, right? I mean, this title is not hyperbole. I'm not trying to be an alarmist. This is reality, right? This is reality of how tough this banking environment is. In fact, mark our words, right? If we stay up here, okay, and the yield curve stays this inverted for another 6 to 9 months, you're going to start to see FIs, community FIs, posting operational losses on a monthly basis. That's how challenging it is. Now, this storyboard here, like you're living this. I understand that. I'll just share a little bit of, some elements of this, because we'll tie back into, some of these pieces as we talk about interest rate risk today. And of course, the Fed tightening has been extreme. It has slowed down this spring and summer. Even with that slowdown, a big takeaway here is that we're still playing catch up with deposit activity, deposit pricing, deposit mix. I'll share in the next slide, how we're projecting, the deposit base to change. Persistent deposit outflows, that's highly unusual in our space. And even that's softening a little bit, right? Like the last couple of months, deposits holding up, but you have to look under the hood of what's really causing the profitability pain for us, which is the mix change, right? First half of the year, non-maturity deposits down 8.5% for our space. Right, down 8.5%. So we're seeing a big change in mix and an uplift of 200, 300, 400 basis points in changing that funding mix to hold on to those liabilities. And that leads to the third bullet point, which is probably cutting the deepest today, which is the massively inverted, yield curve spread. I look at the 3-month to the 5-year point. That's more of a banker spread, 106 basis points of inversion. That's actually improved over the past month, and it's still historically, inverted. And the point is that we've been over 8 months now. The longer it persists, the harder it is to make a buck, right? And that's, leading into the last bullet point I have, which is this loan pricing conundrum. In the narrative and the circles that we're running in, the narrative is starting to change. A little bit less in deposit, focus. I mean, that story's been played out, and more on like, well, what's happening on the other side of the balance sheet, loan pricing. And the conundrum is that spreads on most asset classes have widened out, thankfully, right? We got there. Now the question is it enough? Are these wide spreads still enough, right, to grow at a profitable margin? I'll talk about that a couple of times today, and what type of liquidity premium and how we're assessing that type of growth. That's real tricky, right? Because funding cost pressure is going to continue. We're probably through the worst of it, depending on what the Fed does, right? But we're probably through the worst of it. This is our non-maturity deposit rate forecast. For those of you who kind of follow us, we've been talking a lot about this over the past 18 months. And so I'm not going to get into how we've built this forecast. There's a lot that goes into it. I'll just get right to it. And you can see here through June, the average non-maturity deposit rate, just non-maturity deposits for our clients, $1.02. That's all in. That includes non-interest-bearing checking. Okay. What I've got built out here are 3 projected scenarios. Okay, base. Okay, this is pre Fed hike 2 weeks ago, and up 1 and down 1. Okay. Now, if you go to the right, you can see this is just the 1-year forecast in the non-maturity deposit cost structure. Okay, and you'll notice that if the Fed does stay higher for longer and settles in the 5.5% range over the next year, you can see we're probably around expecting around 30 basis points more of lift in non-maturity deposit costs. And 30 basis points is not a big number, but think about the allocation of your non-maturity shares to your entire funding base. It's a massive interest expense number. right? Massive interest expense number. Even the down scenario, by the way, and this will correct itself the deeper we get into this, but even in the down scenario, I think tells a story. We're still, we're not expecting much funding cost relief if the Fed were to cut 100 basis points. That's the catch-up factor that we talked about, before. So, okay, Joe, we get it. It's tough. It's scary, as Bill says. How do we attack it, right? So this will be our agenda. Again, Eric will go into the interest rate risk modeling stuff, gaining more confidence. How do we get there? The do's and don'ts of an inverted yield curve. The further we live with this inverted yield curve, the harder the decisions become. We'll talk about that. Asset and liability sensitive playbooks. What does asset and liability sensitivity even mean? Everybody on this call may feel like they're liability sensitive today. We'll talk about that. Right? Having derivatives in the toolbox. Interesting. Why we think it's a must-have, must-need. And then I'll finish up with some, kind of strategy and pricing considerations from both sides of the balance sheet. Now, the focus of today is managing margin, earnings at risk, right? That's a big focus. That is the focus of today. Now, with that being said, there is something that can get in the way of us attacking those challenges. And I think we all know what it is. And I have to spend some time on it, which is that very friendly NEV supervisory test, and so we got to talk about it. So what you're looking at here with these squiggly lines, just look at the gray line. This is just the trend, okay, of credit unions that we see, okay, that have basically moved to high risk. It used to be high and extreme, and we kind of grouped them together. It's high risk, right? And so if you look over to the right, what you notice is, if we were to layer in the Fed funds rate, that would be interesting. If we layer in the Fed funds rate, it'd probably be high R squared, right? More than 3/4 of credit unions out there are testing at high risk, which is, again, got to be careful. I don't want to go down a rabbit hole here, right? But the point being is that, there's a lot of high risk classifications on NEV soup test because of the nature of how that's been built, right? And the flaws. Now, the flaws, we all know the flaws. The NCUA knows the flaws. They've admitted them by changing the guidance last year, right? And getting rid of extreme risk, and getting rid of the automatic DOR and de-risking plans. Okay, good. That's been good. What we'll say is that it's starting to pick up activity again in terms of more focus, maybe more de-risking plans. And maybe this is a byproduct of some of the bank failures, and more focus on, NEV. So I just figured I'd share a little bit of commentary before we get back to our program here. A couple things. Number one, if you got an exam over the next 6 or 12 months and you are at high risk, I would be building storyboards into my ALCO, meeting around this. Hey, what you're going to see, high risk, but let me take you on a journey of all these other schedules and data analytics and simulation and stress tests, that maybe show a different story, and get this stuff documented, educate the board, having those discussions. Okay. If you find yourself in a position where you end up in a, de-risking plan, okay, and again, we're hearing, this is bubbling up, and we're having, credit unions come to us about this. Some real things you got to be careful about, in building those de-risking plans. Okay. And we're happy to, I'm working through one right now. Happy to share some insight and thoughts on this. I think one of the big takeaways that I would focus on is I wouldn't be setting, dated targets, right, of meeting specific requirements of where I'm going to be 6, 12, 18 months down the road. Rather, I'd rather put together a 2-year growth plan and say, I don't know how we get there, or I know how we get there. I just, it's going to take some time. Be careful on those dated targets, because we know we fall victim. There's really no fixing it, right? Time will fix it, right? And we fall, victim to the, to rates. And if the Fed does stay up here for another year, it's going to be really tough for a lot of credit unions to kind of go back to moderate risk. So, what I'll leave, you with before I hand it off to Eric is, if you're going through this, or you want to help plan, or you want some feedback on a de-risking plan, or getting ahead of this, we're happy to, share some insights and thoughts and be assistance in that regard. Okay. So with that being said, I am excited to introduce my good colleague, Eric Poulin.
Thanks, Joe. So where I want to start, I want to leverage some of the language that Joe used early on, right? We're dealing with this period of extremes, and that becomes really apparent here when I start to put together this chart. I'm looking at a cross section of DCG clients, and we're looking at the breakout between asset sensitive versus liability sensitive. And what you'll notice here is all the way on the left-hand side, this is pre-COVID. This is Q1 of 2020. And the breakout was about 60-40, liability sensitive to asset sensitive institutions. Roll the clock forward, and we're now dealing with government stimulus, right? We're in the thick of it as it relates to the pandemic. And a lot of those stimulus funds resulted in deposit growth on our balance sheet. And for many of us, that's untested funds, but it's sitting in checking accounts. And the checking accounts that are on our balance sheet today, we look at those as relatively non-rate sensitive. And so you can see these risk profiles flip-flop. And now there's a much higher weighting towards asset-sensitive institutions versus liability-sensitive institutions. You roll the clock forward one more time, and now we're dealing with this shocked rising rate environment, right? This period of extremes. And what we're finding out is that a lot of these untested funds are actually much more rate sensitive than what we had initially anticipated. So this is creating this cloudiness, this confusion around our risk profiles, right? Are we asset sensitive like we were before the pandemic? Are we now liability sensitive with these new deposits, right? And those questions are really, really hard to answer without diving deep and adding a little bit of data. And these are things, by the way, that we cannot control, right? These are outside of our control. Even the things that are within our control with some of these reports and analyses and schedules are also creating a little bit of confusion. Joe and I are lucky enough to be able to see a lot of different ways that people approach this process. And here are some of the common challenges, some of the common feedback that we receive from those folks. There's too many numbers. I'm a very, very visual learner. It's tough for me too, right? To look through hundreds of pages of dense, microscopic financial information. It's so hard, to look at page 40 in a rising rate environment in month 13 and understand exactly what that's telling us when you're just looking at, small numbers on a page. Too many scenarios. And this one, I mean, we're a little bit handcuffed, right, by some of the regs where we have to run ramps and shocks and the NEV and the NEV supervisory test, like Joe said. But what do we focus on, right? That's really hard to answer. A lot of these reports have a short-term focus as well, right? 1 to 2 years. And as bankers, we know that the products that we sell are, right, if we're thinking about loans, for example, more than a 1 to 2 year time horizon. An auto loan, a residential loan, right? That has cash flows out past that 1 to 2 year window. So it's valuable for us to open that lens and look through a larger time period to understand how those cash flows cycle back through. And then finally, assumption uncertainty, right? This is one of the most challenging things in today's environment. The inputs that go into your model, right, by very definition, the word assumption, it's extremely difficult to know for sure exactly what is going to happen with those assumptions, right? So we have to make an educated guess. How we make that educated guess has changed dramatically. We're starting to leverage data using data analytics, and I'm going to give some examples of that today. So how we have been able to generate much more confidence and clarity in these interest rate risk models are with the following, and these are things that I'm going to focus on through the next section here. Graphs. Told you I'm a visual learner. I mean it, right? That's how we display these interest rate risk scenarios. It's much easier to see trends and inflection points when we're looking at that picture, right? Instead of dense pages of just small numbers. Scenarios that matter. I want to be careful here. What I do not mean is that we are sitting around an ALCO table taking bets on, hey, what might happen with the yield curve? What might happen with rates in the environment? I was at ALCO 2 days ago, and we were talking about the projection for Fed funds at the last time that we met, right? And it was actually that rates in the market were going to come down. And if we had made wholesale changes based on our strategy, thinking, hey, 3 months, 6 months from now, rates are going to be lower, we would have been wrong. And so instead, to take a step back and look at scenarios that matter, and what I do mean by that, right, is if you're an asset-sensitive institution, for example, and you have potential exposure to a falling rate environment, a down 2 might be a scenario that matters for you. right? It all comes back to that kind of cheesy mantra that Joe gave at the beginning, right? Of listen to your balance sheet. As silly as that may sound, it really resonates with me when I'm looking at some of these profiles to help, again, develop that confidence. For what it's worth, focus more on earnings at risk versus value at risk. So NII, net interest income, versus NEV. Joe mentioned earlier the importance, right, of having an understanding of what that calculation is telling us in terms of the NEV and the supervisory test, but also understanding that that may be telling us a very different story than what our earnings at risk simulation is telling us. So having that full, all-encompassing story, again, really takes that one step further in terms of understanding our overall risk profile instead of being, again, handcuffed to that just regulatory exercise. Last but not least is pro forma simulations. Again, the way that my brain works, it's really tough to be sitting around a table and saying, well, what happens if we take on this strategy and maybe we add these types of loans? Or what happens if we start to experience additional deposit outflows? Well, from my perspective, let's run that through the model, right? Let's run these things that we are feeling, experiencing, thinking about strategically, or challenges that we might be experiencing as well, and run that through the model. And I'm going to give some examples of how we're doing that as well, again, to bring that conversation to life and develop that level of confidence. Here's the example that we're going to walk through here over the next few slides. This is a very, very common base case NII trend that we see among many clients, again, that we're looking at these positions for. And I know I just told you to let's look at a wider time period, right, than just 1 to 2 year window. And here we are. I promise I'll open this up. But what you'll notice here, right, this upward trend. Why? Well, in these models, typically the way that we approach these, right, is asset cash flow as it comes back to us, we're redeploying that at today's rates. And in many cases, that's much higher. On the other side of our balance sheet, funding stays relatively static, right? Our deposits contractually don't always change, right? Non-maturing deposits don't change. And so that stays the same in the model. It generates this upward trend, right? Asset yield improvement, funding costs staying relatively the same. Assumption uncertainty, right, from the previous slide is one of the main things that's causing confusion about this profile, because it doesn't always feel like we look like this. So we are starting to introduce what we've called dynamic deposit assumptions. This is, I think, from my perspective, again, you know that how my brain works by now, much easier when we kind of bring this to life with an example, with some illustration. So I'll do just that. This is what we mean by dynamic deposit assumptions. So there's a lot going on here. I'm going to focus primarily on the lines. What you'll notice here, right in the middle of the page, trending backwards through time, is a dark blue line. For this institution, that's their rate paid on deposits, again, back through the time period that you see here. There's a light blue line that's on top of that line, and it trends very, very closely, right? It's kind of tough to see, but that's the point. That's our model back testing. Hey, what if we were to project back through time? What would the model have said this institution is going to pay on their deposits? So you can see that's a very, very tight fit line. That tells me two things. One, I have a tremendous amount of confidence in what this model would have projected back through time for this institution. And second, if I flip this calculation around, so I'm no longer looking backwards through time, and instead I'm looking prospectively, I'm forecasting, I can now substitute out some of these variables in this sophisticated calculation to say, if rates change in the future to X, Y, or Z, what does that now do to my projected funding costs? So you can see, right, these lines that trend out to the right-hand side, these checked lines, show different rate environments and what this institution's funding costs could potentially look like out on that time horizon. So back to Joe's point earlier, right, of the sophisticated model that we've built out that shows about 20 to 25 basis points of continued funding cost increases, this institution is feeling the exact same thing. That's the green line here, the base case scenario that trends upward, right? So if this institution is building in to their interest rate risk model no change to their funding costs, it's actually different than what they're experiencing, right? So this adds that layer of data-driven assumption support. Another point to make here, Joe mentioned it too, right? This still continued funding cost increases in a down 100 basis point environment. And to me, I like to think about things kind of how it works, mechanically, right? Down 100, what that's referring to is, hey, our wholesale rates, our comparative wholesale rates, all of those come down 100 basis points. But the difference between wholesale rates and the rate that I'm paying on my deposits right now is so darn wide that even if those wholesale rates come down 100 basis points, it's still valuable for me, liquidity-wise, relationship-wise, to pay those members a higher rate to retain those balances. So that's where we're seeing still that positive funding cost increase in a falling rate environment. For this institution, it takes 300 basis points of market rate decreases for them to finally start feeling that funding cost relief. This is important to know for the model. Why? Well, it changes the overall risk profile. So again, a lot going on here. On the right-hand side, same institution. Now we're opening that window up 5 years, right? And we're layering on some other scenarios here. So you can see the colored lines, the orange and the purple, those are rising rate environments, the dark blue lines, falling rate environments. And on the right-hand side, you can see that there's a mismatch there, right? They have some rate sensitive funding that as rates are increasing, you can see that trends downward below the base. And there's funding cost relief in this base model because those falling rate environments trend higher initially, right? But once we are right-sizing these assumptions, we're including that data-driven approach, you can see how that changes the risk profile on the left-hand side. A lot of that near-term exposure benefit is neutralized, right? All of those lines now trend along the same trajectory, and you can see how that changes the projected NII results in the gold square rectangle down below. So this is not necessarily saying, hey, you're going to be making, less net interest income. This is saying, hey, we are right-sizing these assumptions. So now we're looking at a truer representation of our overall risk profile, right? We're right-sizing this process. Now, to this extent, right, we've been talking about rates and rate changes in the model, but many institutions that we're talking to are also feeling some pressure on the volume side, right? We're experiencing, and Joe mentioned this too, right? Leading up to the last couple of months, we were experiencing consistent deposit outflows that stabilized recently, but what if, right? And this is where that pro forma really comes to life. What if I'm continuing to experience some of those deposit outflows that I now have to replace with wholesale funding? And you can see how dramatically that changes this risk profile. Again, on the right-hand side, pretty rosy picture, right? Trending upward, we're doing better. On the left-hand side, now that's flat in year one. And that's, again, right-sizing for what if my continued deposit outflows persists, and now running it through the model to see, again, how that changes the overall risk profile. So it seems complicated, right? There's a lot that goes into this, but adding in those data-driven approaches can create this level of clarity so that when we're looking through these reports around an ALCO table, talking about strategy, we can do so with that much more confidence. Joe alluded to the inverted yield curve a few times, right? So some do's and don'ts. I want to introduce some data to this part of the conversation. And what we're looking at here, this is, some of you may be very familiar with this chart already. This is the spread between the 3-month treasury and the 10-year treasury, right? So that difference between the two. And what you can see how it's kind of trended over time here. And there's a couple of points where that spread, right, that slope becomes negative, where this blue line trends below 0. And right after that period, you can see that there's a gray shaded vertical line, right? Those are periods of recession. So usually following a period of an inverted yield curve, it's followed by a recessionary period as well. Fast forward all the way to the right-hand side where you can see this deepest inversion over 40 years, followed by no recession yet, right? And so now we are patiently awaiting, right? Narrative from the Fed on a data-driven approach, what that means, what their outlook is to see, right? If we are going to see a gray shaded area, we're going to see a reversal of that trend. Layering on top, right? Those Fed decisions, you can see this red line here. And so the Fed typically will hike as that spread narrows, eventually trends below 0. We trend into this recessionary period. And then the Fed very quickly thereafter will reduce rates. So again, very wide spread in today's environment remains to be seen, right? If we're in that soft landing, hard landing, or no landing type experience. And then lastly, I'll layer on top here the 5-year treasury. So you can see again, over the last 40 years, that yield has come lower and lower and lower until most recently it's trended higher, which creates some very interesting investment opportunities and considerations if, again, your balance sheet can withstand some of that. And the final point that I will make here, especially as it relates to this blue line, is that spread, when it becomes negative, when the yield curve inverts, is only that way for a very, very short period of time. Usually because very quickly that recessionary period kind of bubbles up and then we have to reverse course. That hasn't happened yet. So we're still in that deep inversion, like Joe mentioned, and it remains to be seen just how long we are going to be down here. The longer we are in this inverted yield curve, the tougher it will get to not make any wholesale changes, to not make any big decisions. Because here's what we're dealing with, right? Kind of the 101. This is what the yield curve looks like. I think I put this together yesterday. And so you can see, right, the short-term points on the yield curve, 550, longer-term points, maybe look at the 5-year point, 100 basis points lower, right? So how are we supposed to look at this? Well, the Fed controls the short end. We know that, right? The market traders typically will control longer-term points, right, by their purchase activity. And that longer-term points is signaling that on the longer term, right, rates are projected to be lower. So, okay, what does that mean, right? Does that mean that the whole yield curve is going to come down? Does that mean, and you can see, right, how very quickly this can turn into, what about this? What about this? What about this? And again, before we make any wholesale decisions, one, let's run through the model to see if our balance sheet can withstand that. And two, let's understand that these inverted yield curve periods are not this way for an extended period of time. So while right now it does seem cheaper, right, to extend out our funding, longer term points on the yield curve, right? Why wouldn't I extend 5 years to save 100 basis points? Well, if you're an asset sensitive institution that has exposure to rates down, that could potentially exacerbate that issue, right? You want the ability to recycle that rate lower and lower. And if you extend out your funding, you can't. So we want to make sure we're coming back, we're listening to our balance sheet. Sounds silly? I'll say it again, right? Got to listen to our balance sheet. And then some, again, final takeaways about some things here that are very, very tempting in an inverted yield curve environment. But it's important to put them out there, to understand, to take caution, right? Optionality risk. We know that we can get, a few basis point spread premium on the bond portfolio, for example, if we were to add some optionality to those securities onto our balance sheet. But again, does our balance sheet call for that optionality? Same thing for overextension, right? Not to necessarily belabor the point, but understanding if we are going to extend funding because we are taking, that basis points back to us, understand how that fits into our risk profile, if it fits into our risk profile. And then finally, on the loan side, right, reaching for yield, it can be tempting, but understand where we are in the credit cycle, right? Staying disciplined there, staying disciplined with our credits, with our underwriting process, extremely important, especially in this period of time with the inverted yield curve that typically does not, stay for an extended period of time as well. The good news is that there are some things that we can do, right? If we're asset sensitive versus liability sensitive. So I'll take the asset sensitive side of the house and then I'll turn it back over to Joe. This is a very, very classic asset sensitive posture that we see among our clients, right? So you can see that we call it an alligator mouth, right? The purple line, the orange line rates up. You can see that this institution does better. And then the solid blue lines, there's potential exposure there. It trends below the base case scenario, those bar graphs. If this is you, these are some thoughts, questions that we've been asking, that we've been bringing to that conversation, right? To help deepen that understanding, feeling more confident about this profile, and then understanding what are some of our options. Are we feeling liability sensitive? Right? Are you like the other institution that I just showed, right? We just walked through the example of that is experiencing continued funding cost pressure in today's environment, experiencing some deposit outflows, right? So although our risk profile looks like this, if we were to add some of those more intangible, right, situations that we are feeling today to this exercise, does that change this profile or our conversation? What about maybe it's time to do the opposite, right? So to bring back that example of, hey, it makes sense, right, in my mind to save 100 basis points to extend out my funding 5 years. Maybe it's time to do the opposite of what it feels we should be doing, right? Because of what our risk profile is calling for. Call protection is also extremely important, right? Very, very important to consider that in today's environment, right? Call protection, for example, could be extending out your loan portfolio, right? Booking some of those longer term loans. Call protection in a falling rate environment helps an institution. Understanding your capacity for fixed rate assets. Joe's going to walk through a great example of this, how we bring this conversation to life. I will headline first, of course, that capacity is very, very different than appetite for fixed rate assets, but understanding that there are guardrails there that we can establish makes that conversation so much more detailed, right? And then finally, keeping funding short if asset sensitive is your posture. And we talked about, right, the example why. Now, one last point that I'll make here is that these rising, falling rate environments that we're showing, these are parallel rate shifts. So every single point on the yield curve increases by 200 basis points or decreases by 200 basis points. Now, the yield curve typically doesn't move like that. The way that the yield curve will typically move is, say it starts out steep, right? The yield curve will flatten, then it inverts, and then it steepens again, right? As something happens, the Fed cuts rates, and there's steepness there. So what happens if we go from this inverted yield curve to a steeper yield curve? We decrease those short-term rates, something happens, right? The Fed comes down, and longer-term rates stay anchored. Well, if that's the case, that's this gold line. That tells a very different story than a parallel falling rate environment, right? So this is getting a little bit into the weeds, but understanding that even the shape of that yield curve and how that changes can also dictate or change the way that we're having those strategic conversations. I took the easy side for asset sensitive. I'll turn it back over to Joe for liability sensitive.
Yeah, thanks, Eric. And if you're structurally liability sensitive, it's tough today, right? It's tough because rates have gone up so much so fast, and exacerbated by this, really inverted yield curve. When we talk about liability sensitive, what we mean is that we have exposure, right, in a rising rate environment to our margins. And if rates go down, we do a little bit better, at least for a while, right? Now, this is generally, created by the fact that, simply put, we have more shorter term liabilities than we have shorter term assets. And there's nuance to that, right? And sometimes that can be tricky to figure out. Just ask the NCUA, right? And meaning that as credit unions, traditionally, we don't have a lot of floating rate assets outside of HELOCs, right? We just don't, right? And I'm generalizing, but we also don't have a ton of really longer term assets. And of course, we have some, and so how does all that fit into the mix? And so, a couple of things to think about as we're talking about setting the stage for strategy discussion, right? Which is number one, if we're feeling the pressure today, say you're thinking about, you get some term, you get some short-term funding, trying to figure out what to do. Understand the tenor of your exposure. Where are you exposed? This is part of the reason why Eric was talking about opening up that window, right? If you're not looking at graphs, you may not see this, what you're seeing in the picture. Right? If you're just looking at percentage changes 1 to 2 year basis, you're probably not going to see this. Right? Understand the tenor of your exposure and what you're looking at here. So the orange line and the purple line, those are rising rate scenarios. The dark or navy blue lines, those are falling rate scenarios. A traditional near-term liability sensitive posture here, right? And again, this is pretty common in the community FI space, which is, again, I don't have a lot of floating rate assets, but guess what? I don't have a lot of long-term assets. And for, especially credit unions, it's very common to see it like at least half of the loan book cycling through in 2 years. We've been talking a lot about that, right? With the shock and awe of rates coming up, and we're like, man, we just need some time. And these 4.5% asset coupons are going to start rolling off. We're going to price those things up. It's coming, right? It's coming. And so you tend to see this where it's like, I've got a little bit of a near-term pinch. Because of that, some liabilities are pricing up a little bit faster. But man, when those assets come through, that's what's going to start helping, recover this thing, right? And so we talk about that to really understand if I'm trying to position term funding, derivatives, whatever the case may be, you really want to understand where you're exposed, right? And so in other words, this balance sheet, looking at it, if you're just looking at 1 year exposure, like, man, I need to put on 5-year funding, right? But they actually don't need funding beyond 3 years. Get that. Can we self-insure? A lot of times, natural growth is the best insurance policy, right? Shifting, this is a scenario you should all be running, right? Which is, how much runway do you have to shift investment cash flow into loans from a liquidity perspective, and then model that out? How does that, take care of some of the pressure that Eric outlined on the deposit side? The wild card there, and I'll get back to this a little bit later, which is, are we growing at a healthy spread today? Disciplined funding approach, that's a pretty open-ended comment there. You talk about on the CD side, what could be undisciplined is like a 5% CD special with not a lot of protection and might cost us a lot at the margin. I'm also thinking about this again from the wholesale side. Joe, I hear what you're saying. This balance sheet doesn't need much more than 3-year funding, but man, I could save a whole heck of a lot more if I go out 5 years. That's the point of the inverted yield curve what Eric was just talking about. Most of the time, you put more basis points in your pocket today. What type of risk could we be adding down the road? Listen to your balance sheet. And then finally, hedging strategies. Okay. This is something we feel strongly about. That for the ones that can, put on derivatives, we think it's a must-have that this should be in your interest rate risk toolbox. Got to be, It's got to be. The good news is this is permeating through the space. It's being more widely accepted. And I'll talk about why. Okay. You need to have this in the toolbox. Now, by the way, we're coming at this from an angle that's completely unbiased and independent. We don't sell derivatives. We don't have an inventory to clear, right? We just think it's that good of a tool to have. Having this discussion next week with a brand new client, and how to, another avenue to help manage risk. Now, we do a lot of primers. I personally do a lot of derivative primers for credit unions in boards, okay? And when I do these primers, I tell you, man, all I start with is the why. Why? Why should this be in our toolbox? Okay. And if you go to the first pillar here, if I leave you with nothing in this section, I hope I leave you with this, which is that we use derivatives not to speculate. That may be the stigma, right, attached to derivatives, but we do it to insure. And one thing that I've had a number of clients execute derivative strategies this year. And what I'll say to them before they hit the go button is say, I don't want you to realize a healthy spread on this swap, on this floor, whatever the case may be, right? I don't want you to, right? Because generally that would mean the rest of our balance sheet is getting its butt kicked. We're using this, right, as an insurance policy. Now, we would be happy to get a little bit of a payoff on the insurance policy, but that's a really nice way to have this settle in on the why. Flexibility. If you have exposure to rising rates, you don't have short-term funding, it's like, well, what the heck are you going to do, right? You can't just force short-term, floating rate assets on the books. Right. And so there's flexibility where you could, if you have a big mortgage book, you can say, you know what, I want to selectively take a piece of that and flip it to floating for the next 2 years. Flexibility. You do it off the balance sheet. That's what I was just talking about. FASB has made things easier. There's an oxymoron, FASB and easy, but they have. This came out in 2017, and they basically want to say, community shops should be, it should be a little bit easier for them. To hedge and add protection on the balance sheet. You talk about a portfolio layer hedge method. That's what I was just saying, in doing a hedge against a fixed mortgage book. And it is becoming more common because of this, right? And the need to add, more tools to the toolbox. You're seeing a lot more credit unions get involved with derivatives. If you're thinking about this and this sparks something, here are the initial steps. Number one, just start with the education, start with the why. If interested, again, I've got a 30-minute primer ready to go. Yeah. So if you're interested in us, sitting down with you or your team and going through that phase 1 education, happy to do that. Understand who the right partner for execution would be. We've got some thoughts there. Getting your policy, you got to understand the accounting. That's the biggest piece probably. But your partners should help with that. And of course, well, Joe, this, what could go wrong, right? And understanding the risk, and that's all part of the education. Let me just give you an example of how this has worked. This is, a strategy for a client. You can see this is from the beginning of the year. They executed on this swap strategy. Okay, now these graphs look different than what we showed you before because we have a derivative analyzer. We could just kind of plug and play, put in different notional swaps, and out comes the results. It's really flexible. But you can see, if you look at this graph over to the right, the green and the red, they're rising rate scenarios. Okay. And this was, a couple of, probably 100 basis points, 150 Fed basis points ago. They had some exposure. And so we looked at the idea of just doing a simple receive float pay fixed swap. And we did it against the mortgage book. I just want to take some of those mortgages and just pick your tenor. I want to just flip them to floating for the next 2 to 3 years, right? Blend that thing out. And so you can see, how it tightened, right? It tightened. It didn't eliminate risk. We're not trying to eliminate risk. It tightened the lines over to the left, right? To add some protection. Now, they executed, right? And so they're happy. Oh my gosh, we got this at such a low rate where we got a nice wide spread. I'm like, whoa. The rest of our balance sheet, again, look at the margin. We're happy that we have this, sure, this insurance policy. But again, think about why we did this, because we're trying to protect against quote unquote our worst case scenario. That gets us grounded again on the importance of using derivatives and why we would use derivatives. Okay, so that's an important strategy consideration to wrap into the whole interest rate risk discussion. Let me get into some stuff on the loan and the deposit side to finish up for today. Some thoughts on the lending side. I isolated this bullet point kind of last minute because this is probably the one thing I want to leave you with on the lending side, okay? Which is taking a hard look in the mirror and thinking about loan growth and pricing. And, in other words, should we temper loan growth by raising our rates today versus potentially growing at a negative spread? Okay. And sometimes we see that, maybe it's often, right? Where if you really look at the numbers and you look at the CD activity and the cannibalization, the cost of funding that sometimes is close to or even above, loan pricing. And so this is an important takeaway and an action item, right? To first off, understand the second piece of this. What is it costing me to grow, to bring on funds at the margin today? And should I change it? Should I change it? Right. And should I, if that's the case, and it's so hard, it's tough to change that, do I get more defensive on the deposit side, maybe take a step back, let some deposits leave because of the cost at the margin, backfill with wholesale, and maybe raise up my loan rates a little bit? Now, I know that goes against the credit union mantra. I get it. Joe, this is our membership base. You're telling us to not be at the top of the market on deposits and raise loan rates. Yeah, that's not what we're about. Well, this is, again, reality of how tough this environment is today, right? And this might just be a short-term thing, okay? But again, when you look at it, and we have, institutions telling us the fear of posting, losses, operational losses on a monthly basis. This is what we're talking about. So understand what it's costing and do that analysis. We've done this analysis for a lot of clients, and it goes a long way. And so that comes back to, I got some, pricing thoughts, and, again, spreads have widened out. Are the spreads enough? Are the spreads enough? Whether we're talking auto, whether we're talking mortgages, right? Here you go. Look at 20-year MBS today, slight discount, 5.35 yields. Okay, obviously 30-year MBS higher than that, probably closer to 5.75 to 6. How does that equate to, what you're pricing at to get volume today? Hey, think about that. Again, understanding the spreads and whether we need to attach a liquidity premium to those spreads. Whether it's auto, you got some examples here on the commercial side. If you are doing business lending, okay, and if you're allowed to do and embed prepayment penalties, man, the value of options today, given how high rates are in the inverted yield curve, are probably the highest they've been, the most valuable they've been in a long, long time. I would rather give up some yield if I'm doing that paper if I have strong prepayment penalties. Joe, you're going back and forth a little bit. Well, it's talking about different books, right? And how I'm operating and negotiating in this environment. Eric mentioned something about, especially if we're asset sensitive, understanding what our capacity is to put on fixed rate assets. Okay. How can we talk about putting on fixed rate assets? We've got all these fixed rate assets. They're extended out. I want to keep everything short. Heck, the inverted yield curve, I get paid more to keep, assets short than going out. Yeah, it's like, okay, yeah, sure. It's very much an anomaly. But if you are more of an asset sensitive structure, which by the way, you do see that for a lot of credit unions because they have a strong core funding base and a relatively short-term asset base, right? And the market is demanding for more fixed rate, loan production. The question is, can we take it? Does our risk position, our balance sheet allow us to put that on? Then you can work the yield curve and pricing, right, based upon the overall strategy and the focus, from that perspective. But so although we may not have the appetite, do we have the capacity? It's a different question as Eric framed it, right? How do we get there? This is such a simple exercise. You can all do this. I've seen this, get very well received, particularly in the board level, and it's very simple. Take out your repricing gap. Okay, this is an example. Okay, and so first thing, look at all of your assets that are set to reprice and mature beyond 5 years, longer term. In this example, it's 100 million. Is that good or bad? Well, some will look at that as a percentage of assets. Doesn't tell me much, right? Look at that as a percentage of, well, how do I support those long-term assets? What do I have for long-term core funding on the balance sheet today to support that? Share drafts, shares, capital, haircut shares and share drafts. Haircut them 10%, right? Because of the sensitivity that we're experiencing today. In this case, right, 5-to-1 split, 5-to-1, right, in favor of core funding supporting longer-term assets, only utilizing 20% of core funding for long-term assets. Do they have capacity? The answer is yes. Eric executed this strategy with a client. Hey, I got some pretty good flexibility on maybe filling a bucket with some fixed rate mortgages. Now, I know there's negative convexity and all that stuff, right? But we're talking about working the margin in our strategies today, and what fits for us. The fill the bucket approach, man, it's such a great concept. It's simple. Let me fill a bucket, whatever size. Let me start with 15 million. If you're 750 million, that's a drop in the bucket. It's not going to change your risk profile. You start with the, fill the bucket approach. Okay, what did it do to my risk position? You come back next quarter, look at ALCO. How did it change? And how does that influence my strategy from here on out? Great way to approach it. Okay, a couple of comments on the deposit side. My colleague, Billy Guthrie, and I co-hosted a deposit strategies webinar 2 weeks ago. If interested, we kind of went in detail on these subjects. It's right on our website under events, if you want to find. It's called the deposit difference. And for those of you who have been listening to us on the deposit side, we might sound a little bit repetitive, but there's some serious, focus. And we're at the point of the cycle, right, where it's all about retention. Just protect what we have, as hard as that is. And we're also at a point where we're a lot more targeted, okay, in our pricing decisions. Okay, so here's an action item. I mentioned 8.5% non-maturity deposit outflows first half of the year. Where have you seen the leakage, the pain? Okay, is it happening at the top of the food chain? Accounts over 250K. For a lot of you, I wouldn't be surprised if you're starting to see some, movement in that awkward tier, 50K to 250K. We got maybe thousands of accounts in that bucket. How do you address that? Right. And so the point is, when you can get a better understanding of where the pain is happening, now you can be more targeted in how you approach that. I've even seen some credit unions that have, like, I don't know if it's a reverse psychology, but they're like, there's nothing I can do on that tier. I can't price it up enough, and I don't want to stop the attrition. I'm actually going to lower rates. I'm like, whoa, some wizardry there. To talk about call lists and campaigns. We get a question frequently, hey, what do you see working to grow core checking relationships today? I'm like, it's a tough environment to make that an initiative. You're going to have more success growing from within than you are bringing in new money. Here's another action item. Take a list, right, of all your single source money market and share accounts, over 25,000, whatever the tier may be. Okay. There's so many different plays there. I'm sure marketing would have fun with that list, especially if you have a rewards checking product. Like, this is the environment to unleash it. Right? Like the low balances that qualify for the rate is usually a very small percentage. I would be unleashing that, right? And gain some energy. On the money market side, so much focus. Money markets are taking off. We were predicting this. I'm sure this got a little bit, accelerated through some of the bank failures. And what I mean by that is, a lot of people are taking a step back and saying, you know what, I'd rather make a move at the top of the money market than the CD market. So we're going to top of the markets, I think, already at 4% now. Right. So I generally see kind of, three different buckets. Ones that have just been, pricing, individually, right? Kind of doing the exception pricing, haven't touched rates. You see another tier that's just working their existing set, their legacy money market set, working with a big credit union that's doing that now, that's struggling. And others that roll out a new product every cycle, right? And obviously there's some overlap there, but some takeaways. If you've just been doing exception pricing, what about the depositors that you haven't touched? I had a brand new first-time ALCO meeting a couple of weeks ago. Similar situation. They've priced up 50%, all accounts over 100K. They priced 50% of them up, and they're all like 3.5%. Yet they're still seeing aggressive money market outflows. Take a look at the other 50%. Who are they? How long have they been banking with you? What storyline do we have? It's like, let sleeping dog lie, but they're not asleep anymore, right? And you've got to have a targeted approach. For those of you who are working, you're pricing up your legacy, tier set or money market set. We've been saying this for over 18 months now. Review your tiers. I think a lot of you have done that. I've got a tier concentration, strategy discussion in about an hour and a half with a credit union. See where your concentrations fall. Revamp those tiers to get more pricing flexibility. And if you haven't done it already, go through the exercise. If I were to roll out a new money market product, what would it look like? Just go through it. It's a healthy exercise. What would I call it? How would I price it? You're going to have a lot more leverage on how you structure that product, for money markets than you do for CDs. premium savings, same deal, right? In terms of new money, tie in with active checking. On the CD side, here's another action item. What is your CD objective today? Ask that question to your team. Right? What I mean by that is CD books are up 30% this year. So a lot of folks are saying, I'm going to take a step back, right? I'm coming up to the first wave of those, CD specials in this cycle. And I'm just going to take a step back, and I'm more in the retention play than growth play. And the point I'm trying to make is if you're just out there with a 5% CD special with no hooks, I don't think that's going to meet the objective that you're looking for. At least that's what we see in the data. You're probably going to see a lot of cannibalization. You can price differently from a retention. For whatever reason, I see 4.25 a lot. 4.25 seems to be the number to retain versus to win. If you're going out to grow, your offering should look different. If you're going to be at 5.25, you should ask for new money. You should have a tie-in, with checking accounts. And people hate it when we say that. New money. I'm not saying new money only, right? But you should have some sort of ask. New money. Ask for 25,000 of new money if you're at the top of the market. Right. And I know it's tough to do that. I know you get pushback, but you got to have your, if you pair that up with a retention play at 4.25, you got a 5.25 new money. Now you got a menu of options. How do you deal with objections? What's your sales script, sound like? You get it. And then the last thing in terms of staying active, this is just an interesting idea that we'd share. We had a client that had a sales day, put it on the calendar 2 weeks from now, right? Do it. And say this, we're going to do nothing, just hit the phones, right? They had an existing member set. They had, potential new depositors. They had the product set, their scripts, and boom, they just, dial for dollars. I thought that was an interesting idea. So I'll wrap up with a comment that I made a couple of times already, which is really understanding the cost of the funds today, right? And how that equates to the spread and the margin impact. And so this is just a simple exercise, take it, if you think it'd be helpful for your next ALCO meeting, of looking at like a top of the market, money market play versus a top of the market CD play. And I'm probably not high enough on the CDs, and this is an exercise I went through with a client. Top of the market for them would be 375. Top of the market would be 5% for CDs, probably closer to 5.25 today. And their total average deposit rates are $1.25. And so, this is not like high math, but it's just showcasing the difference. Like, hey, I go out with a money market product today, even if I see 40% conversion. In other words, for every $10 I bring in, $4 is coming from someplace else on my balance sheet, is shifting over. I can have 40% conversion and I'm still below short-term wholesale. You don't have any wiggle room, practically on the CD side. I would do this also looking at your upcoming CD maturities. If you get CDs coming due at 3.5 to 4%, and you do this analysis on a 5% play versus a 4.25 play, I think that'll be eye-opening. So with that, we're going to wrap up here, Bill. Key takeaways, try to gain more confidence on the interest rate risk, use data analytics, tell a story, get your storyboard going. Listen to your balance sheet, tell your story. We've said that a couple of times. We really, really believe it. And at the end of the day, ALCO, never want to look at, easy for us to say, right? Use this thing as a vehicle to drive strategy. A lot on the line today. Margins are under pressure. You all know that. So with that, Bill, we said a lot. We'll catch our breath and see if we have any questions in the chat box.
Thank you, Joe. Thank you, Eric. Yes, as usual, that was a information by fire hose, I think. At least for me. I'm sure there's some finance folks out there who are following along the whole time. Any questions? You feel free to throw them in the chat. If anybody would like to unmute themselves and ask, please do. As I said earlier, this is recorded, so you can review it and or share it with your staff or board later. And as always, Joe and Eric have shared their contact information. I know they're very open. If anybody has any questions and wants to reach out to them directly and you don't want to discuss it in an open forum, they're very responsive with that. Let's see. Okay, got a nice compliment there. Okay, nice. So people are thanking you. It's a good
Yeah,
sign
we need
so
that for
far.
the ego. Yeah, keep them coming. We need that for the ego.
Yes, so if anybody has any comments that you'd like to drop in before we sign off, please do. I'll leave the session open for you to be able to do that. But again, I just want to thank Joe and Eric for just your cooperation, and always so easy to work with, and to be able to come out here and provide this, good information to our members. We really,
No, thank you for the
TCUA
opportunity.
really appreciates it.
Likewise,
Our
appreciate the
pleasure.
opportunity.
All righty. You both take care. Everyone, thanks a lot. And we'll see you at the next one.
Take care, everyone.
Bye now.